Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NABORS Industries LTD quarterly report. NABORS Industries Ltd. offers a diverse range of businesses and services, including drilling and drilling-related services for land-based and offshore oil and natural gas, wells tubular running services, casing and tubing running, torque monitoring, managed pressure drilling services, drilling bit steering systems, and rig instrumentation software drilling systems, rock kit, SmartNav, SmartSlide, rig cloud, land-based drilling rigs and marketed platforms, rigs operation, manufacturing and sales of drilling equipment, top drives, catwalks, wrenches, drawworks, aftermarket sales and services for installed equipment. The significant drop in NABORS Industries Ltd's stock price over the past year can be attributed to a combination of disappointing financial results, challenging industry conditions, and company-specific operational headwinds. Key factors contributing to this decline include weak earnings reports, mixed performance in various quarters, and broader industry downturns. NABOR's poor Q4 2024 earnings report, which included a substantial miss on earnings per share and revenue shortfalls, set the tone for the year's stock price drop. The company's subsequent earnings reports, including mixed Cone 2025 results and disappointing Q2 2025 performance, further eroded investor confidence. The oil and gas drilling sector experienced a decline in active rig counts, lower crude oil prices, and historically low natural gas prices, reducing the incentive for new drilling programs and leading to declining day rates and utilization challenges. NABOR's company-specific weaknesses, including increased operating costs, rig churn, and a significant debt burden, also contributed to its stock price drop. The cumulative effect of these factors resulted in a 35.25% decline in NABORS Industries Ltd's stock price over the past year, with some reports indicating even steeper declines earlier in the year. The primary drivers of revenue growth or decline in the company's financial performance are multifaceted. On the growth side, operating revenues increased by 12% from 2024 to 2025, driven primarily by a 15.4% YoY increase in Middle East and Asia region revenue and a 181.1% surge in Drilling Solutions segment revenue. Key drivers of revenue decline include a 36% decrease in investment income and an 11% drop in total revenues and other income. The U.S. drilling segment experienced a minus 3.6% decline, while the rig technology segment saw a significant minus 22.7% drop. Other notable factors influencing revenue growth or decline include the disposition of Quail Tools, which contributed to revenue growth, as well as the gain on bargain purchase related to the Parker acquisition. Additionally, industry-wide trends such as spending by oil and gas companies, oil and natural gas prices, and the number of capital programs underway or planned also play a crucial role in shaping revenue performance. Net income and profit margins. A significant turnaround. NABOR's financial performance has undergone a remarkable transformation in recent years. The company's net income has shifted from a significant loss of $55 million to a substantial profit of $357 million, marking an impressive increase of $412 million. This turnaround is also reflected in the improvement of operating margin, which has increased by 5.1 percentage points to 7.4%. The U.S. drilling and international drilling segments have seen their profit margins improve, while the rig technology segment experienced a decline. The significant change in net income can be attributed to various factors, including changes in depreciation and amortization expenses. However, the primary driver of this improvement is the company's ability to adapt and respond to changing market conditions. NABOR's efforts to optimize its operations and increase efficiency have paid off, resulting in improved profitability. This turnaround has been a major achievement for the company, demonstrating its resilience and ability to navigate challenging times. The company's financial performance indicates a steady improvement in its ability to generate cash from operations. The net cash provided by operating activities has increased by $14.9 million, from $432.5 million in 2024 to $447.4 million in 2025. This positive trend suggests that the company is effectively managing its resources and generating sufficient cash to support its business operations. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level has experienced mixed results over the past year. while long-term debt decreased by $157,233. Total liabilities increased by $31,971. However, the overall debt level has still increased, page 33. In terms of interest expenses, there is conflicting information, but it appears that they have slightly decreased and then increased. The company's interest expense decreased by -1.8% from $55,350 to $54,334, but later increased by $7.5 million, 5%, from $157.2 million in 2024 to $164.7 million in 2025. The company's financial performance varied across different segments and regions. Notably, the United States segment performed well, with land-based drilling operations and offshore platform drilling operations contributing positively to the overall results. Internationally, the Drilling Solutions segment saw a significant increase in operating revenues, rising by 78% to 70%. On the other hand, some segments struggled. The Russia region underperformed due to issues with operations and property, plant, and equipment located there. In the United States, the drilling segment experienced a decline in operating revenues, decreasing by 2% to -6%. Additionally, Rig Technologies saw a substantial drop in operating revenues, falling by 22% to -20%. Overall, while some segments showed improvement, others faced challenges that impacted the company's overall financial performance. Management's outlook on company strategy. Management has a positive outlook on the company's performance due to the acquisition of Parker Drilling Company, which will expand its global energy markets presence. They expect to achieve cost savings and synergies from the acquisition, although these are not included in the pro forma results of operations. However, management is cautious about the company's outlook due to various risks and uncertainties, including geopolitical events, fluctuations in oil and gas prices, and competitive changes. To mitigate these risks, they aim to innovate the future of energy and enable the transition to a lower carbon world. The company has sufficient liquidity with cash and short-term investments of $428.1 million and working capital of $744.2 million as of September 30, 2025. Management expects to remain in compliance with all covenants under the 2024 credit agreement during the next 12 months by taking actions such as reducing discretionary capital, monetizing assets, and accessing capital markets through alternative methods. Overall, management is focused on navigating the company's growth while managing risks and maintaining liquidity. The company has made significant transactions in the past few years. Notably, it acquired NABORS Energy Transition Corp. II through an initial public offering and merged with Parker Drilling Company. On the other hand, it divested Quail Tools to Superior Energy Services for $625 million. These acquisitions and divestitures reflect the company's strategic efforts to expand its operations and optimize its portfolio. The company has a history of paying dividends to its shareholders. Notable instances include the payment of $6,052 to former Parker shareholders and $87 in 2024 to common and preferred shareholders. Additionally, the company distributed $186.7 million from its trust account to NETC-II stockholders as dividends paid. Concerns about inventory buildup are evident in the financial summary. The data reveals a significant increase in inventory levels from 2024 to 2025, with net inventory rising by $19,904 and raw materials and work-in-progress inventory levels increasing as well. This buildup is further highlighted by an inventory buildup of $62.9 million on September 30, 2025, compared to $44.6 million at the end of 2024. These statistics suggest that there are legitimate concerns about inventory buildup, which could potentially disrupt supply chains if not addressed. That concludes the financial summary for NABORS Industries LTD. Feel free to comment below, and I will be happy to answer them when possible.